The 70% downgrade in Bellamy's share price in the past 10 days highlights an important but often overlooked part of a business: working capital. Working capital is essentially the net amount of money owed to and owed by a business for the products or services it has supplied or received, plus the amount of partially developed and finished products stored but not yet sold by the business. Most businesses try to minimize their working capital because it's expensive. Money owed to a business incurs interest and opportunity cost, while inventories need to be warehoused, financed, and maintained. But managing working capital is not easy, especially for small, partially integrated manufacturers of perishable goods that are trying to grow quickly. If they hold too little inventory, they run the risk of losing customers, but if they hold too much inventory, they run the risk of spoilage and write-downs. To make matters more difficult, they often enter onerous take-or-pay contracts and don't get the best commercial terms. In many respects, these are what led to Bellamy's financial difficulties. Bellamy saw an opportunity to grow its branded dairy product sales in China and entered into a number of fixed-volume supply contracts to meet the anticipated demand. No sooner had it entered into these agreements than Chinese officials announced a wave of new product control and importation restrictions. Bellamy's quickly found itself holding large amounts of perishable inventory with a commitment to keep paying for more inventory that is expensive to warehouse and difficult to sell. An unfortunate position, but one many growing businesses can find themselves in. And because of this, I decided to look for companies that could be in similar positions. Of the 76 retail and manufacturing businesses on Shareclarity, 9 had marginally lower working capital to revenue ratios than Bellamy's, and only 1 had a higher ratio. Comvita. Its working capital to revenue ratio was 42% last year, and it is the subject of this month's deep dive. Comvita is a vertically integrated manufacturer of branded Manuka honey, olive oil, and other natural and medicinal products. It's listed on the New Zealand Stock Exchange under the ticker CVT and has an enterprise value of about $400 million. Its share price increased by 50% at the start of the year, but after releasing its June full-year result and higher inventory levels, its share price has since fallen by 40% to $7.90. It is now trading at a forward EBITDA multiple of 11 times, which is below where it's been in the past, but in line with other food and beverage manufacturers. It's also trading at a discount to the $10.28 valuation on Shareclarity. When I looked at the overview on Shareclarity, I was keen to understand Comvita's supply chain and where its products were sold. I wanted to see how much of its sales could be affected by China's import restrictions and how quickly it could reduce working capital if it needed to. Comvita's supply chain is relatively straightforward. It owns its own apiaries and olive groves and sources other ingredients from New Zealand and Australian suppliers, which it then processes, packs, markets and distributes from its manufacturing facilities in New Zealand and Queensland, Australia. More than half of its raw honey and olive oil comes from its own apiaries and trees, which have low operations and maintenance costs and are not exposed to any fixed offtake agreements. The rest is sourced under contract from farmers, many of whom are paid in shares, so Comvita should have enough flexibility to reduce its supply chain and reduce its supply without triggering any take-or-pay obligations. Interestingly, honey is non-perishable, so unlike other food and beverage manufacturers, Comvita's products don't easily spoil. Holding excess inventory therefore tends to be expensive, but it's unlikely to be written off. On the sales side, about a third of Comvita's products are sold in New Zealand, a third in Australia, and a third in Asia. But collectively, a higher percentage is likely to end up in Asia. Being vertically integrated should make it easier to satisfy the Chinese authorities of its supply chain and product integrity, which suggests any slowdown in Chinese sales may be temporary. Furthermore, there is excess demand for Manuka honey globally, yet the supply for Manuka honey is limited to New Zealand and parts of Australia, so Comvita may be able to maintain sales by redirecting its product to other countries. Comvita releases its half-year result next month, and the key things I'll be looking at are, firstly, whether its revenue growth remains above 15% per annum and on target to reach $400 million by 2021. Secondly, in which countries most of its products were sold, with particular interest in Chinese sales through its new distribution partnership, Shenzhen Comvita Natural Food. Thirdly, whether its working capital, especially its inventory levels, have stabilized or reduced from the $95 million it held at the end of last year without write-downs or discounts. And finally, whether it's continued to buy more apiaries with the aim of doubling its hives from 36,000 to 85,000 in the near term. I'll obviously be also curious to read any commentary around Comvita's olive oils businesses and the outlook of its investment in Sea Dragon.